CRM reported their earnings after hours yesterday, and today they are down 21%. This has had a knock-on effect for other companies in the software industry like Adobe that is down today more than 5%. In fact, year to date it is down 24%. It is right there trading towards their 52-week lows, and it is one I am considering adding. And as we can see, we have a double buy rating with a hold from Seeking Alpha. Today we're going to do a deep dive into this company, whether or not it looks incredibly undervalued, one to consider. As always, we'll look at their free cash flow growth, sales growth, their debt levels, a lot of information, as well as looking at both insider buys and sells, institutional movements, whether they've been buying or selling over the more recent quarter. We'll also take a look at their latest investor presentation, what the expectation is for quarter two when they release in a few weeks. And as always, we want to see with Adobe, what is the growth looking like, both on the income statement, their top line revenue versus their bottom line net income, but also the health of this company, their total cash versus their total debt. And what we also want to do in today's episode, not only run it through the valuation model, getting to our intrinsic value, as well as our acceptable buy once considering our margin of safety, but we also want to take a look at the discounted cash flow model, go through 3 different growth rates so you understand where the valuations are coming from and really see whether or not this has a lot of growth and one we can get behind around the current trading price. So first, let's take a quick look at the historical performance, and as we mentioned, 2 out of 3 buy ratings. It also trades for a forward P a little bit lower than this. It hasn't quite updated for the drop, so right there towards the S&P average of 22. And as we mentioned, very poor year to date, 24% down. If you've been a shareholder over the last 12 months, however, you would be up around 8%. And over the longer term, as we can see, over the last 10 years, up 614%. But we do notice their all-time highs were sitting some time ago at the back end of 2021 near that $700 mark. Now, in terms of their growth, as always, we do want to see 3 to 7%, more of a baseline bottom end. What we know with this company, very strong growth, 4.1 billion in 2014, latest annual accounts 19.4 billion, so we are talking about nearly 5 times growth over the last 10 years. And when we look at it graphically, that is very beautiful, those consistent increases over the longer term. So already off to a good start with this company. Can we see the same on the bottom line net income? Well, a little bit more inconsistent, nonetheless very strong growth, 268 million in 2014, 5.4 billion in that more recent annual accounts. And we can see over the longer term, we do see that growth, although over the last 4 years, it has been a little bit inconsistent. Nonetheless, looking very strong, bottom line and top line. It is what we like to see. Just would like to see a bit more consistency and a bit more growth over the more recent period on that bottom line. In terms of the health of this company, very important, cash versus total debt. Total cash and short-term investments, well, 3.7 billion in 2014, 6.8 from that latest quarterly report. So it has more than doubled. We do note a bit of inconsistency. Nonetheless, over the longer term, that cash position has been increasing. And quite importantly, we do need to compare it to their total debt. Otherwise, on its own, it is fairly meaningless. What we can see then, total debt, it has increased to 1.5 billion to around 4 billion. So when we can take a look at it graphically, we do notice pretty much up until 2018 it was increasing and then fairly flat over the longer period. What is nice to note, their cash position is higher than their total debt, so that is off to another good start with their balance sheet. If they wanted to, it would take them just 1 day to pay off all of that debt net of their cash on. Now, very important to look at their earnings, their track record, as well as their future expected growth. What I like to see, it is here, 4 beats out of the last 4 quarters. That is very positive and in fact very strong, at least 10 cents or more. The more recent one in quarter 1, they did do a very nice beat as well. So 100% track record. On top of that, forward-looking double-digit growth expected into Q2 of 2024 and high single-digit growth over the next 3 quarters. So always like to see that forward-looking on the earnings per share. And when we do take a look at the next 2 fiscal ends, November 24 as well as November 25, we can see the expected forward PE. So it really does depend whether or not you believe that this is justified by the performance of the company. But so far, this is a very strong company that does tend to increase double digits pretty much across the board. So let's take a look then at some of their metrics. The first one is the valuation. Now, as we always say, bear in mind we are comparing it to a sector median, and in fact when you look at the sector, it could include some that are fairly poor, so it could be justified. Have a quick look then. So we will look at the PE non-GAAP basis. 26.51. It is marginally higher, 12% in fact, than the sector median of 23.66. So you could argue maybe it is warranted when we do take a look at the next essential underlying metrics. And if you do prefer to look at others rather than a PE non-GAAP basis, you can see them on screen to include them in your own essential investment thesis. Another one that we can look at essentially on a price to cash flow forward looking, 26.31, again marginally higher, 13% higher than the sector median of 23.19. We then move on to the growth grade. Now this is where we start to understand why this is priced slightly higher on a PE basis. In terms of the revenue growth year on year, well 11% with the sector median at 3.02%. Forward looking, again anticipating double digits, whilst the sector is essentially around 6.62%. On top of that, another very strong metric that we can see over the longer term, so the next 3 to 5 years, they're anticipating 17% increase to their earnings per share year on year. What we can in fact see the sector median around 13.8. So in fact pretty positive when we do look at the growth metrics, and that can be said for the majority of these. Again, if you do want to incorporate them into your own analysis, you can take a look at some of these where they do compare them to the sector median. We then finally move on to essentially the profitability, where an A+ pretty much right across the board there. In terms of the gross profit margin, that is phenomenal. Probably one of the best that we have seen, 88% gross profit margins, what we do tend to see in the software industry. But then when you compare it to the sector median, 50%, the same can be said for the bottom line net income margin, 24% versus the sector median of 2.7. Not sure why that isn't an A+ as it should be. Very, very strong. And when we also take a little peek at the cash from operations, 6.8 billion versus around 91 million for the sector. So in my opinion, so far at a high level, it does look like a lot of these metrics are warranted for Adobe, as they are a lot better than the sector median. But as a quick recap for this section, a double buy rating, a hold from quant, a D evaluation, a B- on growth, and an A+ on the profitability. Comparing their performance to others in the industry in the application software, we have the well-known SAP, Intuit, Salesforce, which in fact we did just review today after the massive drop, so do go check that out, as well as a few others that we have also checked out on the channel. Now, in terms of looking at their performance, well, over the last 12 months, Adobe is up around 8.41%, but it does make it one of the worst performing, in fact, marginally better than Salesforce, which we looked at today, down 2%. When we expand this over the last 5 years, we do see Adobe up around 65%. Again, one of the worst performing. Ideally, you do want to get a better return on your investment over a 5-year period. And when we expand it over the last 10 years, we do in fact note they are sort of in the middle of their competitors, up 576%, which in my opinion is a very strong return on your investment over the last 10 years. Just remember though, with all of this information is past looking, and in terms of the future, none of that really matters because their performance from the past isn't correlated to their future performance. Now, in terms of insider ownership, we have 0.15% with one instance of an insider buy, although fairly trivial, with 8 instances of insider selling, around 50 million over the last 12 months, so the same period. And in fact, you only need to go to the more recent quarter, Q2 of 2024, to see 1.42 million worth of sales. Now, who are these people? Well, we can clearly see the EVP, Scott B, in fact, on the 2nd of May, sold over 2,700 shares for a share price around $474, 1.3 million. So again, whether or not you want to include that or any of the other information, we do have more selling towards the end of April, so you could argue that is fairly relevant. You can see that a lot of insider selling. Do let me know though if you do think this is a bearish signal, or you do believe, for example, that they do sell for other reasons, whether it's personal or financial. We then move on to institutional ownership, just under 82%, 16 billion worth of sales over the last 12 months, but we see a significant amount of buys over the same period, a lot more. In fact, we see double the amount of buys in Q1 than we see sells, and the same can be said for the previous quarter. So in terms of institutions, they are buying a lot more, not just in the more recent period, but also over the last 12 months, whilst we see a heavy amount of insider selling. As always though, do let us know your thoughts, but do remember to always do your own due diligence, never copy what insiders or the institutions do. Now, we just want to let you know we have released our latest free weekly article running through the best recession-proof stocks for your portfolio based on historical performance. All of these articles are completely free. Do click on the pinned comment below. You can sign up. Whether or not you want to read on how to find undervalued stocks, going through all the websites and resources we use, or 20 undervalued dividend stocks that we do believe should be a contender for ads in your portfolio. Now let's jump into the earnings call. Let's take a look. Now no surprises, it has been printed on Adobe, so let's go straight through. And what we can see from their quarter one performance, their growth is very nice, double digits, around 11% year on year, as well as the different segments within them. We can see, in fact, the digital media up 12%, the digital experience around 10%, and their subscription revenue up around 12%. So that is very positive. We're also going to talk about this shortly. They are doing a lot of repurchases, in fact, a massive amount, but it is something that they did do in terms of quarter one, and we can see a large amount of cash flows as well, something we do like to see on this channel. The other thing we did want to point out was in terms of the expectation of the next quarter. So we can see 5.25 billion to 5.3 billion. Just as a quick reminder, if it did skip your mind, they had around 5.18 billion in Q1. Q2 then they are looking for an increase as well. So not just over the year, but quarter on quarter, this is a company where they do increase their top line revenue. We do like to see this on the channel, and we can see their earnings per share estimates here as well. Now the one thing that I want to draw your attention, maybe it's something that you missed, is the fact that in March or the middle of March, they did announce a massive 25 billion stock repurchase program, which is always great. They effectively believe that their share price is fairly low, and that is why they are buying, or that is something that we assume. Otherwise it would be a bit redundant for a company to spend that much money on a lot of share buybacks. But again, always very good to see, effectively returning excess cash to investor pockets, as you do own a much larger portion of the company through this method. So then let's take a look at the underlying metrics. Now one thing we always want to make known, free cash flow always over the earnings. It is susceptible to manipulation by management through accounting, and increasing cash flows is what you want to see. Now, they're not very inconsistent, in fact, pretty consistent as you can get. 229 in 2014, so massive growth to 1520, although that is a drop from the previous year. Nonetheless, 2024, they are anticipating much larger growth, around 1960 per share. So this is what you want from companies, continually increasing those free cash flows year on year, or at least over the longer term at a bare minimum. Sales growth, as we said, they continue to grow by double digits, which is what we love to see. Now, you could argue it has started to slow down from around the 20s that we've seen. It has started to slow down as we see the last 2 years, 10% and 12%, but even on the trailing 12 month and the expectation for quarter two, it is going to be around 11 to 12%. Still very good. It doesn't necessarily mean that this is completely slowing down, and if you do believe in this company, then today, as we're about to find out, could be a potentially good opportunity to buy. In terms of shares outstanding, as we mentioned, not only are they doing a share repurchase program for a massive amount, but also they've reduced it a fair amount over the last 10 years. Maybe not as much as we'd like to see and not very consistent, but this is better than nothing, again, for a company that doesn't pay a dividend, although a fun fact was they have paid a dividend in previous years, 458 as we can see on a trailing 12-month basis. Total sales then, very strong, just another format to what we covered earlier. And ROIC, personally for me, this isn't one that I do like to invest in if a company doesn't have 10% as a minimum. What we see here is much better, and it has been increasing over the longer term. Just on a trading 12-month basis, 36%, making this incredibly attractive for potential investors. And remember, we do want 10% as a minimum, just to give us faith that management are able to effectively allocate their capital. On top of that, what do I always say? Not only a minimum of 16% operating margin, but we do like to see it ideally increase over the longer term. And we do see that, so some operational efficiency and also some very high numbers in the mid-30s over the last few years. And on a trailing 12-month basis, free cash flow margin looking very strong as well. Not only has it increased over the longer term, but very consistent, even with a 33% on a trailing 12-month basis, looking at one of the lows over the last 10 years. So lots to love about this company, and if all that wasn't enough, on a net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, we have 0 over the last 4 years, 0 anticipated next year. And remember, these are the number of years it would take the company to pay off all of their debt net of cash on hand. As we discussed earlier, it won't even take them 1 day, and that means then their balance sheet does look very strong, as this does correlate to balance sheet strength. Let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the first model that we are using is the multiples valuation model. If you remember, these are the companies that we took a look at earlier in a similar sector and size. We have their P multiple, the average multiplied by the EPS of Adobe, to give an intrinsic value of just under $692. Some very large undervaluation, as we can see here, but as always, do bear in mind we're not looking at any of these models in isolation. The next one that we're using is the DCF model, discounted cash flow with the free cash flows year on year. Average growth rate 23%, as we can see. Forward looking, now we've gone for 3 different rates, a low, medium and high. We're going to start off with a low rate of 10%. With the discount rate, this gives us the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and this gives an intrinsic value of $502. Based on this, then this gives implied upside around 11%. Now, people may say that is too low. Look at the average, it is a lot higher. So at a 12% rate, we get an intrinsic value of $578. We can see here upside of 28%. Also, do bear in mind you can grab a copy of all of this models by clicking on the pinned comment below, getting to your own intrinsic value and acceptable buy price, as we're about to come on to. Now, there may be people saying go higher, 14%, we can see $664, and this ultimately means implied upside on a DCF model of 47%. Now, we want to be a bit more conservative, so today's episode we are going to go for around 12% in the middle, which we do believe to be fair enough, given the average over the last 10 years has been 23%. And what we'll do is we'll take that to the final calculation. Now, the intrinsic value in today's episode is just the average of these two models, coming to $635. Now, the current price around $452, the margin of safety that we're using is 10% to start off with, and we execute on that if you remember if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that, then it's a buy up to $571, and then we keep going till it's near the current trading price to find out that in today's episode, it isn't right there at a 30% MOS level yet, but pretty much trading at a 25 to 30% margin of safety. And that is really a very high MOS level for a high quality company if you do believe in it in the longer term. Now, in terms of Wall Street and their expectations, well, they see the share price in the next 12 months not far off our intrinsic value. They see upside of 38% and a price target of 625. But as always, let us know your thoughts in the comments below. Is this one you're looking to add? Maybe it's one that's on your watch list, or maybe you need to see it come down a little bit lower. As we said, all of this is based on the fact that we have used a DCF growth rate of 12%. And again, if you do want to grab a copy, you can click on the pinned comment below. But let us know your thoughts. This is one definitely that does look like a very strong buy now to capitalize on this drop. But don't forget, they are also reporting their earnings soon, so it could go one way or another. But don't forget, let me know your thoughts in the comments below. If you've enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.